Ladies and gentlemen, welcome to Modern Fascism, the twin flames of government and corporate working together to monopolize control. Big tech that pulls in the majority of eyeballs are all in bed with government. And at the same time, ESG, which stands for Environmental, Social, and Governance, punishes companies such as Chevron to take responsibility for, say, Amazon's trucks, if those trucks are not conforming to ESG standards. So that's like telling McDonald's to take responsibility for anyone who eats a Big Mac. And recently, Switzerland announced they would put people in prison for up to 3 years if they raised their thermostats above 66 degrees Fahrenheit. And this is all spurred from ESG's wave of quote-unquote woke morality. The entire energy market in Europe is falling apart because of severe ESG caps on energy production. And for every unit of gas that's reduced, the slack is picked up by Russia and China. ESG should stand for export Soviet gas. Methane, which is a form of carbon, is 80 times worse for global climate change than carbon dioxide, yet we think we're helping the planet by shifting production to Russia and China. Major companies such as BlackRock gain state favors in China by forcing companies to adopt ESG practices in the United States. This weakens the US because the Chinese companies are not forced into the same crippling ESG standards, which are uneconomic. The ESG movement opposes not just fossil fuels, but also nuclear energy. Vanguard's ESG funds exclude nuclear companies. We have reached a point where the appearance of virtue becomes more important than actually being virtuous. The virtuous action that results in economic benefits is being quashed by leftist woke virtue signaling that carries highly uneconomic consequences that is largely responsible for soaring inflation. The end result of the ESG industrial complex is not about climate change, but an attack on human productivity in the West relative to other parts of the world. Russia has a long history of outlasting its opponents through cold, harsh winters. If the Russia-Ukraine conflict drags on through the winter, this could spark a revolution in the EU, as many families will be unable to heat their homes. With electricity and gas prices spiking, it's going to be a long winter. Now, the first chart that you see there, it's a drawdown chart that shows Bitcoin is down about 73%, and Ethereum down about 82%, and the S&P down about 25%. So the past two bear markets in crypto show Bitcoin was down peak to trough 84 and 87%. Ethereum was not around in the first crypto bear market, but was down 95% in the 2018 bear market. In the worst stock bear markets, of which the current one is looking to be, unless postponed by massive money printing, the S&P 500 was down between 50 to 60% in three vicious bears. That would be the crash of '73, the unwinding of the dot-com bubble in 2000, and the Great Recession of 2008. The market was actually down about 90% during the Great Depression of the 30s. But these graphics are misleading. A drop from 80 to 90%, and you can see that some of these things are ripe for dropping, let's just say dropping into the nether regions when they're already down a lot. So when you drop from 80 to 90%, it's not a 10% drop, but a 50% drop. It takes 100% gain to go from a 90% drawdown to an 80% drawdown. And it takes a 900% gain to go from a 90% drawdown back to break even. So should Bitcoin drop to 84 or 87% like it did before in past bear markets? That would be a drop to a price of about $11,000 to $9,000. Or in percentage terms, a drop of about 44 to 54%. If we take levels around, say, 19,500, it's bouncing right now, but nevertheless, it's a big drop. And Bitcoin could fall even further, as it has lost as much as 94% twice in its price history prior to the 2014 bear market. Today's macro environment is looking far worse than at any time Bitcoin has been trading, and where goes Bitcoin, so goes the rest of the crypto space. Indeed, the space valuations currently hover around, I guess, well, I haven't looked in a while, but I think it's still around 1 trillion. But should Bitcoin fall to 11,000 or 10,000, then, well, expect valuations to drop to roughly 540 billion. In stocks, should the S&P 500 drop 50% from its peak, that would be a 33% drop from current levels, or 2409. Now, I think that it doesn't take a rocket scientist to know that we're in treacherous times, and these kinds of bounces that we're seeing are highly likely to be bad bounces, but we've also shown that they can persist for a while, and they can wear traders out. So you obviously have to pick your spots when you're shorting into logical areas of resistance. Now, I wanted to talk about the Fed funds rate and how it tends to peak into crisis situations. And this is that next slide here. If you look at global debt in 2021, it hit $303 trillion. So if the Fed funds rates get to 4% by the end of this year, that will equal $12 trillion in debt servicing costs coming out of taxpayers via governments which are dead broke, and it'll also come out of businesses. So of course, central banks will just print their way out of this mess if they have to, but because debt is so massive and inflation is soaring, and interest rates are still well under historical norms, they will only be able to print just enough, which could spur one of the worst stagflationary environments on record. And you'll notice from the chart that stock markets often did not find major lows for many months, even after the Fed funds rate peaked, such as during bear markets from January 1973 to November 1974, or December 1980 to March 1982, or March 2000 to October 2002. We also have October 2007 to March 2009. And in each case, a black swan event forced the Fed to lower rates. Since the Bank of England was forced to buy bonds to reduce rates, especially for home mortgage holders, half of whom would have been unable to service their mortgage payments at the higher rate of interest, expected domino effect of sorts from other central banks, such as the ECB, and eventually the Fed, who find themselves forced to buy bonds to reduce rates. So stay tuned for the fireworks. Gil, how are you seeing everything?
Well, I think you had a nice two-day rally, and it made complete sense from a technical point of view. And you have to remember, oversold rallies will occur in bear markets from time to time, and they will tend to be face-ripping types of rallies, which is what we've seen over the last 2 days. What do we do, like 1,600 Dow points in 2 days, right?
Yeah.
So it goes nuts, and it seems absurd because it's all based on the premise that the Fed is about to do what the Bank of England had to do last week, which is respond to some sort of crisis somewhere and immediately open up the fire hose, the QE fire hose. So on its face, with all the Fed heads running around this past few days, talking about how they have to fight inflation and they're going to get it down to 2% and blah, blah, blah. In spite of all that, they've been rallying the market, and that's because you basically get this preponderance of bearish sentiment, and what happens is you basically have dry kindling. You need some absurd news item to get it moving the other way, and with a lot of people positioned short, that forces short covering. So the rallies will tend to last 2, 3, maybe 4 days at most. We saw more of a bear market rally back off of the March lows. Well, I'm sorry, off the June lows, I should say. And you can see that in the S&P chart here. And now we've come all the way down. You broke to lower lows on Friday. So what's interesting is that over the weekend, you had news that Credit Suisse was in big trouble. And I think they are. Whoops, that's not the chart I wanted. I want the weekly chart. Where are you, weekly chart? Here you are. So you can see what's been happening at Credit Suisse. This sort of reminds me of a lot of the bank stock charts back in 2007, 2008, as they slowly just evaporated. And so, of course, the CEO comes out, I think on Friday or over the weekend, and says that they're capitalized, sufficiently capitalized. They don't have any liquidity issues. And if you go back and check your stock market history, they did exactly that. In 2008, Bear Stearns assured everyone that they were fined in March of 2008, and Lehman Brothers did the same in September of 2008. And I can tell you from my own personal experience, I had 2 hedge funds that were domiciled at Bear Stearns in March of 2008. And the week before, I'd actually been shorting Bear Stearns stock, and it was coming down. And so that seemed weird to me. And so I called up our reps over at Bear Stearns and asked them, hey, what's going on here? Your stock is dropping like a rock. And of course, they assured me everything was fine, and their higher ups, their managers, or whoever their bosses were assuring them everything was fine. And I thought, something's wrong here. So I've essentially liquidated both funds. I didn't know what was up.
Alert target has been reached.
Uh-oh. Anyways, so that with that week, the stock is plummeting. I blow out all the positions, go to cash. On Friday, Bear Stearns goes under. So for the whole weekend, I probably went through about 100 pairs of underwear. That's probably the worst weekend of my life, as far as at least from an investment point of view, because we didn't know whether, $68 million in assets was going to go poof or not. So, but I can tell you that everybody will tell you everything is fine, and then it's not. So don't assume that because Credit Suisse tells us that everything's okay, or the CEO does, that that's necessarily the case. But of course, that conjures up, it sort of rekindled this idea that we saw last week when the Bank of England panicked that the Fed is going to face a similar crisis somewhere as something breaks amid this aggressive, or this Fed aggression with interest rates, and that they're going to have to turn the fire hose of QE liquidity on once again. It seems absurd on its face, given what the Fed heads are out saying. The other thing is that inflation is running at 8-9%. Gas prices are rising again. So the big component in helping to flatten out the CPI, what was it, last month, Chris? I forget. But in any case, when it flattened out, maybe last month or the month, last month, okay. That's not going to be there this time around. So you got the CPI next week. You have the jobs number on Friday. Today's ADP jobs number was, I think, slightly above estimates, but they've got to get interest rates above the rate of inflation at least. So basically, you got to get positive real interest rates, and so there, interest rates at 9%. If it continues to go higher, and I contend that it's going to go a fair bit higher. Okay, and it's going to have its little, leveling off and maybe even little pullbacks here that everybody will get excited about. But I think it's eventually going higher. And so we can count on something nasty happening. But at some point, I also believe, and I think, Chris, you agree with me, that at some point the Fed is going to pivot. Whether they do so by quelling inflation first or not, they may just give up and surrender to inflation because all their buddies in the banking industry are about to be decimated, and so they'll come running to the rescue. Consider that right now they're doing about $2.5 trillion in overnight reverse repos. So basically, what's happening is they give money to the banks. The money is given back to them by the banks, and then they pay the banks 3.05% interest on that money overnight. It's a nice racket, right? Nice work if you can get it, but it just shows you how corrupt the system is. And so don't expect it to be anything more than corrupt going forward. So anyways, so that's my diatribe. Now, the interesting thing going on and I view this sort of as confirmation of my theory that when the Fed finally does pivot, and Chris and I both agree that they will at some point, they're either going to surrender to inflation or they're going to create massive deflation by collapsing the economy, then I think precious metals are going to go nuts. Now, Bitcoin, crypto might, but my own opinion of crypto is that for the most part, you can take any analysis that you read of crypto right now and just instead of crypto, insert the word tulip, okay? And that's basically what you have. I think the thing that most people miss is that cryptocurrencies ran up for the same reason that absurdly valued or infinite PE stocks ran up in 2020, 2021. There was just this flood of liquidity, and people, their imaginations were caught up in the whole promise of crypto. But the bottom line is that crypto has not lived up to its promise, which is disappointing from my perspective, because it has not served as a store of value. It has not served as a means of exchange. It's just been a speculative vehicle, and I think it's been corrupted in the process. So that's all going to have to clean out. We'll see how that goes. But I do think. Go ahead.
Yeah, I would say that, first of all, Bitcoin is a proven store of value. That's its killer app, plus as a defense mechanism, as
But
Jason
Chris,
Lowery.
how can something that
Is.
drops 70–80% from its peak be a store of value and do so very
Well, it's
quickly?
not a store of value. It's not a store of value in the
Oh, okay.
sense that it's stable. It's not a stable store of value, but but holistically, it's a store of value. I mean, that's its whole purpose because you can't prove it. That's
Well,
why
it's
it keeps going
supposed
up.
to be,
You can
right. It's supposed to
drop
be.
95% twice and keep it. That's what these things do. I mean, these things being Bitcoin, because it's really the only thing that's truly decentralized. So, that's why governments try to quash it, because it takes away their control of fiat. And ultimately, that is what's going to happen in the final analysis. But I wanted to also specify that, I know people take umbrage to the word tulip, but I think they misunderstand your point. That is, or I don't know, maybe this is not your point, but the way I take it is that, look, the crypto space has technologies that are already proven out. It's going to, upend legacy banking. It's so much more efficient and cost effective, et cetera, et cetera. But I would say for the 14,000 tokens that trade, out there, I would say that 13,500 of those 14,000 are tulips. In other words, they're going to go to zero. They're Ponzi schemes, whatever you want to call it. They don't have sensible, sound models, and we saw this with dot-coms. Dot-coms had lots of tulips in the year 2000 to 2002. Most of they went broke, and I would say there's just a lot more crypto that qualifies as tulips. But the core of crypto, the DeFi element, the NFTs, and so on and so forth, those are going to continue to prosper and live on. I mean, during a bear market, everything goes down. But the building is still going on, and it's actually quite ferocious to the point where the space is still growing at an exponential clip. So, I mean, ultimately people are looking for the lows, and I'm, all year, I think these talking heads on YouTube have been calling for lows in Bitcoin and crypto, and they're leading their millions of followers to ruin, because this is what happened in 2018. Your average crypto went down like 98%. And I think we're going to see that replay this year again, because macro is actually even worse. So we're going to see it at least as bad as we saw it in 2018. So, and that's why my illustration of that chart, don't let the chart fool you. Just because something goes from being down 80% to being down 90%, that's not a 10% loss in your portfolio. That's a 50% drop. So just people need to be aware of the numbers.
Yeah, I would say you run a crypto fund still, don't you?
I don't run any crypto fund. I mean, we're doing a test. We're doing a small test account, a test wallet, accredited investors, but we are going to be launching one once regulated.
Right. So I was just curious if you are, whether you're short the asset at this point. So, but in any case, let me make my final points, if I may.
No, I've been flat, actually. I got out 2 days ago near the open, because it just seemed like everything was so oversold and extreme. And then that news came out, the economic news came out, which implied that Powell maybe can go a little easier on his rate hikes. So I just thought, I'm going to get out of the way of this bus, and I'm glad I did.
Yeah, definitely. Because as we talked about last week and even the week before, when you're in a position to have an oversold rally, they can be face-ripping rallies. So if you're trying to sit short during those rallies, you're in trouble. So, but one last point I would make, that the way I view crypto, I think the whole thing could be bust, simply because I know people like to refer to fiat. But the bottom line is cryptocurrencies are fiat currencies as well, because they're not backed by any commodity, which is the definition of fiat. Now, some of them have a limited supply, which may be an advantage, but there's also a limited supply of pet rocks out there as well. So I don't know if that alone is a sufficient driver. But I do think that the space is mostly filled with crypto fiat currencies. If you can create, 19,000 of these things out of thin air, that sounds like fiat to me. But in any case, I think it's coming down a lot more. And we'll see where things go. I mean, keep an open mind.
Fiat is controlled by government, and they can freeze your account anytime they want. But if you have that seed phrase in your head, your Bitcoin wallet seed phrase, no one can take that from you, and you can be anywhere in the world and access your money.
Right, and I can hide my pet rocks in the backyard, and no one will be able to take them from me either. So again, that alone isn't a compelling reason to own cryptos, in my view. Well, Bitcoin, that's my opinion. So.
Yeah, no, this is good debate for the record. I love it. And ultimately, pet rocks are not recognized.
I
But
mean,
Bitcoin is
remember a year ago, I was adamant about people being very careful with crypto, and we had some pretty heated arguments over. Some people didn't understand that we've had plenty of heated arguments over many, many years of knowing each other, and they get, oh my God. It's like, yeah, well, it was something to be careful of because the space in general has led to a lot of carnage, and over $2 trillion in wealth has disappeared.
right. Well, we were on the same page there. My gosh, I think we've been calling for. Well, I wrote that piece in November when Powell removed the word transitory, and I said, I think headwinds ahead. And then by December, we were both on the bearish bandwagon.
Well, you're not stupid. You're not going to sit there and see the trend change and not see it. Okay, so I know you well enough to know that ain't going to happen. So, and it didn't because you've been on the right side of the trend since then. So, but anyways, getting back to what I was originally talking about. Is that you saw this huge jack in silver and gold. Silver is leading the way, but as we were talking about a couple of weeks ago, there's something up with silver because of the massive shortage of silver, because it is actually used, has broad industrial applications. Half of it, over half now, of production is used by industry. So there has been talk of, paper price manipulation and the banks being short as much as 800 million to 1 billion ounces of the stuff a piece. And so annual production is about 850 million. So this has been moving, which I think is interesting. And my theory has been that if the Fed finally pivots, the thing that you're going to see move the most is going to be the species, basically the commodities that back currencies, of which I don't think they back any these days. Making those currencies fiat currencies like the dollar. So in any case, you see this pullback. It's interesting how it's holding the low today. The PSLV is. It's holding the intraday low of Monday, which was a kind of a big Bible gap up type of move. Only problem with that is if you look at the futures overnight, it's a continuous move, so there is no Bible gap up in the futures themselves. But it is interesting to see this move. I think it's probably likely to come back in, and I think the Fed is going to kill the stock market along with precious metals and everything in between. The TNX, you're seeing interest rates come in. And I think if you look at this, okay, you can make a big deal out of the drop from 4% to where we're at now. You come down to the 20-day line. But that's a parabolic move, okay? So when things get parabolic, and you'll also notice that parabolic move correlates almost perfectly with the parabolic move in the dollar, okay? When it gets going like that, yeah, you're going to see a sharp yank back, and you give it any kind of little excuse, even the fantasy of a Fed pivot, and I think you're primed for a sharp pullback. So you've had that over the past 5 days here, and I think we talked about watching for this as it started to come in last Wednesday, but now you're holding along the 20-day line. The TNX is holding along the 20-day line. I think that's a pullback. And if that turns out to be the case, then the dollar probably goes to higher highs. And foreign currency havoc is going to be wreaked again on the pound and the yen and the euro and whatever else is out there to get blasted by the dollar. So that's what you're seeing now. So I think this pullback in the dollar is basically run its course. It's logical as a reaction pullback to a parabolic move in both the dollar and interest rates. And now they're going to push back to the highs. So you're seeing the TNX today up strongly. So some questions. Someone's asking about CCJ. Yeah, that's a short here at the 20-day line. But of course, any rally is going to be. And I think also you get up here to 28.47, 28.50. This left side peak on the double top is 28.28. So that's triggered a double top short sale entry right there. And of course, I'm sure UUUU is over here doing the same thing at the 50-day line. Yep. Actually, what I want to do here is give me 1 second here. I want to show this chart. This is the National Association of Active Investment Managers, and you can see that they're sitting here at a 12.61% net long exposure right now, which is close to what we saw in March of 2020 at the height of the pandemic. You will notice, however, that during the bear market of 2007 to 2009, it got it got lower. And also in 2011, this is when it was this period here when silver and gold had a big move, if I recall correctly. But also in August of 2014, you had a lower low in that. And that was, I don't know if you guys remember this, but there was the big flash crash of August 2014, not to be confused with the flash crash of May 2010. But that got everybody pretty bearish because you had some issues in China. And so, you're back down to those levels. So that creates the kindling for a rally. But this number can get a lot lower. So just because it's down here near the May 2020 lows doesn't mean that this is the lowest exposure that you'll see among active investment managers. One member pointed out to me that only over 3 times in the last 20 years has this number gotten below 0. And I think it's these 3 times in here. And so, in 20 years, 3 times, that's not much. And that was very quick breaks to negative exposure. So they were net short on that. But here we are now down here. So we'll see how this plays out. But this is enough, along with the the American Association of Individual Investors at 60.8. If we look at a longer term chart of that, so let's go back 10 years, we can see that, let's go back further than that. Let's go back 18 years. How's that? You can see that it's the highest it's been since the big break in March of 2009. So that was when the market bottomed back then. And so here we are at the highest levels there among retail investors seen since then. So the question then, does that represent money that's just primed to come back into the market? I would argue that it's a lot of it is based on just a moribund state of being for retail investment investors who've just been shellacked by getting sucked into so many Ponzi-like entities. And that would include crypto. So, and all the SPACs and all of the, all the innovation stocks and all this other baloney that was out there. And so they're just creamed. But yet, we'll see if this really leads to a new bull market. I don't think it's going to. I think it's just telling you how out of it the retail investor is. And we'll just see how this all plays out. In any case, let's go to my HGS Investor software real quick and bring that up. So miners in general have moved sharply off the lows. This is actually the best performing group over the last week or so, about the last 7-8 days. And so they're on fire. But, overall, what are we seeing? If we look at, let's look at something else here. Let me just bring this back. These are my notes from yesterday. And it's a candle glance, so I'm going to make this a little bigger here. Let's see if I can get it expanding without it being difficult. All right, here we go. Okay, you know what I hate about this is it's got my name up there, Gilbert. I've always hated the Bert part of my name. And if you ever want me to shoot you, just keep calling me that. So the only people who call me that are my family members, and they do so facetiously. In any case, you can see these are names yesterday I had put onto a list of rallies into potential overhead resistance. So you can see Amazon shortable along here at the 20-day line. You can see something like Celsius Holdings, which is a stock that we've been talking about as a short sale target now that it is a late stage failed base, and it is also a punch bowl of death formation in progress. So yesterday it became shortable at the 20-day line. And this is a list I made about midday yesterday of all these stocks that I wanted to short. Alteryx is short at the 200-day line. You can see that. Let's look at some others. We've also been looking, here's one that I think is pretty interesting. It's not on here. But look at like Enphase. That's just blowing apart. A short at the 50-day line yesterday. So from my perspective, it made sense to come in short this morning because of what I was seeing on the stock charts. Now, I don't have to have huge exposure, but I thought it made some sense after a huge 2-day rally maybe to put some stuff out if I could discern ready overhead resistance or covering point. So certainly the case for these. DraftKings, you see right into the 50-day line. Some of these were almost too perfect. But, you know, and the lithium names, we talked about these in the weekend focus list review. That was a short at the 20-day line yesterday, and today you're busting the 50. Nutrien, here's another one. It was a short at the 50-day line. Well, it ran just above the 50-day line, but today it gaps below it and then busts the 20-day and the 200-day. Some others in here, Paycheck, or Paycom rather, I should say, a short at the 50-day line. So this is the way I operate. I watch the stock charts, okay? You can give me, you know, all the commentary you want. To me, it's all just BS, and it really doesn't matter ultimately. Yeah, I know why the market has rallied for the last 2 days. Everybody thinks, or actually they have this delusion that the Fed is going to come in and suddenly start spraying everything down with the fire hose of QE liquidity. And I just don't see it happening. And so, you know, what I'm watching now are the stocks. And once you get some nice rallies, so even though, okay, if you played something, let's just use this as an example. An original short entry would have been along the 20-day line a couple of weeks ago. If you played this, now you get all excited because, you know, you made a bunch of money quick. And let's say you do cover that because it's down the percentages that you had in mind for your profit objective. And then you get a rally into the 20-day line. That worked too. And then at that point, you're thinking, okay, this thing's going like that, right? But what happens is you get another rally on Monday and it turns back to the upside, but you come right into the 50-day. This is my advice for short sellers. If you've done well so far in 2022, and certainly been a good environment for it, what you can do and what you can afford to do is avoid getting overeager. Just let things come to you. Be patient. If there's big money to be made on the short side, it will occur over the course of at least a few days. So if you're 1 day late or you don't catch the exact inflection point, there are probably going to be other entries, and you can just chill, okay, and not let yourself get caught. You know, so you'll think, oh, I'm going to come after this at the 10-day line. And then the next day, boom, it's gapping up in your face, right? So you don't really need to go there. So, you know, I tend to look for the more extreme moves. So when I'm looking through my watch lists, you know, something like this, okay, that would have worked, but I'm not likely to come after that. I'm more likely to come after something like that because I've got it near the 20 and the 50 right there. In fact, yesterday it stuck itself right between the two moving averages, and today you're blowing apart. So there you go, you know, boom, boom, out go the lights. Somebody's talking about Wolf. This is another great example. This one was actually mentioned to me by a member, and they're actually dead on because you do have, I don't know if we talked about this. Well, this is a very fascinating chart because first of all, you have this big ugly cup, which was not a punch bowl, but it was deep and it comes straight up off the bottom, and then it plays out as a double top short sale entry right there, right here, as it fails. Okay, then it breaks down to the lows, and then finally you're rallying. You come up in here, and now what happens is you have this big, ugly double bottom formation. Okay, and the midpoint, the breakout point is here. Okay, but that's also another double top, and you can see that it actually played out a couple of times, I believe, as a double top on the weekly chart, which probably worked out for a few points on this original failure, and now this time around, maybe it'll work for more. But so far, it's been able to find support around the 10-week line. But if we go back and look at the, but what I want to point out real quickly is that this, therefore, because it's over 50% deep, is a fractal punch bowl or a fractal pod. In other words, meaning it's a portion of this big double bottom. So it makes up the right side of the pattern. And you'll see that frequently among various pattern, late stage failed base. So now this becomes a base, right? And now it's failing. And now that's also, this pattern here is a late stage failed base, which you could consider to be a fractal pattern within this overall formation that includes a failed double bottom base, a double top, a punch bowl of death. And what you're going to realize is that what you call them doesn't matter at all. It's what they do. And I basically give things labels just as a descriptive exercise, and yeah, some of them are colorful, but I can quickly reference, you know, okay, this is setting up as a late stager, or it's a pod, or what, you know, and you can kind of put one and one and one together, and they'll have different ways of working. So in other words, the pod fails when it breaks the 20-day line, the same as the late stage failed base, right? But also if you get a double top, then it fails when it drops below the left side peak here. So that's another way to treat it. Okay. So various setups can play out different ways depending on how they look at where the rubber meets the road, and that is on the daily price action. Yeah, someone says, but that's my problem. No patience. You jump the gun a lot. And the reason I think is that you're like the rat pulling the lever. Okay, think about it. To me, there's no greater rush than making like 40% in your account in 2 days on the short side. Okay, that's a rush. And maybe that's part of my problem too, is that you got adrenaline running and, oh, that feels good, so it's better than sex, right? Well, maybe not. But in any case, what happens here is you and you need to think about this. And that's why I would also read the book, The Hour Between the Dog and the Wolf, which talks about how our physiochemistry is a big factor in in our decision making, and that comes into play frequently in the stock market. I find it comes into play frequently in that manner when you're short, because it's a huge rush. Okay, and what will happen is you want that you want that rush again, you want that fix, and so you want to keep hitting the lever, and you have to control yourself, but develop awareness of how you're feeling from a physiochemical. Am I saying that? Is that the right? You know what I mean? The chemicals in your body, endorphins and whatnot, that trigger highs and whatnot that can be addictive. Okay, like runner's high, for example. So trader's high, we'll call it short seller's high. Let's call it that. In any case, so going back on Wolf, I just think that's a fascinating pattern because it's multifaceted. And so here you are sitting right on top of the 20-day. Could you short it here? You would probably have to wait for a breach of the 20-day line from here. But it is persistent. And I think part of it is because they make semiconductors that are used in electric vehicles, which still remains hot. But at the same time, Tesla is eating it. And I thought it was absolutely hilarious that you get this big gap down break, and Kathy Woods over at ARK Investment Management, ARK Lady as I call her, and I think that that's not a sexist moniker, because she does identify as a biological woman. Therefore, she is an ARK lady. And it also has, sort of parody of religious significance, like Our Lady of Guadalupe for you Catholics. And so, because she's become like this bizarre deity, like they still interview her on TV, but she's been proven to be a complete fool. And I don't understand why the television stations can't figure that one out. So she buys 133,000 shares of Tesla on this day. But where are you going? You're going lower. So, what's up with that? In any case, let us get out of this zone. But as you can see, I make these lists, and I can monitor stocks in real time. Here's Zip. That's perfect short at the 50-day line. And remember, I made this list yesterday. So I'm anticipating a failure, and guess what? We're getting it today, but it's all over the place. So we'll see how this plays out. You could just end up taking profits and then, calling it a day. And we could also bounce around in here. So if some crisis does happen, the bond market freezes up. So far, it doesn't look like it to me. Or there is some, bankruptcy in the financial sector, then maybe you've got the Fed coming in to save everyone. Anyways, that's all I've got. So, I've got the ideas I had yesterday are working. Some of them may still be actionable. You can review this video and make a list of these tickers and then watch them yourself. But you can see how, even Array. See, on this one, I would be more inclined to wait for it to get to the 50-day line, which means I missed it. But that's okay, because there are others in better positions, and I'd rather go after those. Simply because if you're suffering from, short seller's high, let's call it that, you're likely to sit there too long and short it here and then watch it go to the 50-day line, and then you're down another 7-8%. Don't need that. So better just lay back and say, it's not there. Let me go after something else like Alteryx or, Celsius, which is one we've been working on for a while, and go there. So somebody says, was your tweet on First Solar yesterday sarcastic? Well, the high tide flag is the biggest pile of BS on the planet, okay? And if you can't figure that out from reading the book, where O'Neill has a chapter on that or several pages on that, then you're kind of dumb, because he goes back 100 years. And what does he come up with? A total of 13 examples. And one of them, which is Google, when it came public, doesn't even qualify based on the definition of of what a high tide flag is. And then, of course, there's this mythology that a high tide flag, if you can identify it and label it as such, it automatically leads to big gains. And even when I went to my very first IBD workshop, and this would have been in 1994 or 5, someone asked Bill about the high tide flag, and David Ryan, immediately, who used to do the workshops with Bill, he immediately chimes up and he says, as far as I'm concerned, Bill should just take that page in his book and tear it out. And he's right. He was dead right, because you've got 13 samples over 100 years of this so-called pattern. How the hell is that statistically significant? How is it even statistically sound? It's intellectually sloppy and it's BS. So what I don't like is the way there's this half-baked analysis that's done of precedents that IBD does. And this is, in my view, one of the big flaws of Bill's work, okay? And I found many. So did Chris. We used to have a good time with it sometimes at portfolio managers meetings. But in any case, that's another story I'll tell you. But the point is, a lot of the stuff is just half-baked, like the 20% rule. Like if stock goes up 20% in how many weeks? What is it, Chris, 3 weeks or less? I don't know. You have to hold it for 8 weeks. Well, what was that based on? When I asked Bill about it over and over again, he only had one answer. Well, I had this stock once and I sold it to her. Well, it's the same story he tells in the book. So there's no real, comprehensive study of that rule. It just kind of pulled out of thin air. And I think for me, a lot of what I noticed about Bill is that he's an incredible trading genius. And a lot of what he did was intuitive. And a lot of times he was doing stuff that is nowhere in his books, and so you see that in real time. You'd be talking about it. And so I began to realize that they're foisting a system on people that it works great when you have real strong trending markets, but it can tear you up, with a lot of baloney when it doesn't. So that's why I'm sarcastic, because I have pretty strong feelings about how they're misleading the public with this kind of stuff, And, Chris and I worked upstairs. We never worked for IBD. And I use the term IB-dweeb, but that's what we used to call the people downstairs who worked for IBD when I worked upstairs at William O'Neill and Company, which was the institutional business, which was highly profitable, and which a lot of my sales reps in the institutional side were very resentful of, because I think I tweeted this the other day. One day I got some of the reps come into my office and they're pissed, okay? And we had a service called New Stock Market Ideas, which was our ideas, the internal portfolio management team and Bill's ideas, that we put into a book, and it had daily and weekly charts and all the data you needed. And we sold that for $150,000 a year to our institutional clients. So they come in and they throw that book and a copy of IBD on my desk. And they were pissed, okay? And they're like, blah, 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 beep, 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 Gil. How the hell am I supposed to sell this for $150,000 a year when Bill is giving this away for $1.50? And they had a point. So, there's a lot of resentment towards IBD because they didn't make any money. I think they were briefly profitable. I think they finally do have the model, or they got the model to a point where it is profitable. That's why they were able to sell it to the suckers over at News Corp, in my view. So that's where that all comes from. And there's no endemic hate of the organization. Other than that, I think the system was never allowed to evolve. And I have to think that if Chris and I had still been there and we're still there today, things would be different with Bill out of the picture, because we would have been able to take over, frankly. But they never thought about any of that, okay? It was basically an oligarchy, and that was it. In any case. So I hope that explains it to you, Robert. And yeah, I know I just went off for a period of time. But I, it's something that I think anybody who uses CanSlim and understands the O'Neill methods needs to understand, that it's not complete. It's very incomplete, and that can make it dangerous at certain points. Sometimes it works great, when you're in the right environment. In any case, so you see all my ideas from yesterday. These are what I came after. They're working. That's all I know. We're down 282 on the Dow now. It's trying to come up off the lows. The NASDAQ what's the NASDAQ doing? Where's my 620 chart? Let's go to the NQ pound F, the futures, and you're getting a little rally off the lows. So if you were playing, say, the SQQQ this morning, you get a sell signal up here near the highs. It's backing down. You can sit back and wait for the next long entry. UVXY is a little different because it's based mostly on fear. So I'll give it a little more room here if my entry is down in here, or even yesterday, because yesterday we actually had a long entry signal. towards the end of the day in here that I thought, I think it was after hours. Yeah, after hours right in here. So it looked, that looked good to me. In any case, we'll see how this plays out. Somebody says sell HVDO day, a voodoo day yesterday. Well, I mean, I wouldn't get hung up on labels necessarily, but yeah, you do have a low volume rally right into the 20-day line on light volume. So that makes it failure prone. But that was the case for a lot of these ideas that I just showed you on that candle glance view. That's stockcharts.com, which I think is a great service. It's cheap too, and you can work out screens and all kinds of fun stuff with it. And I think the candle glance view is a great way to look at a bunch of charts at once. And I'm pretty good, as is Chris, I'm pretty good at looking at charts very quickly and discerning what I like and what I don't like, what's set up, what isn't set up. And so that's a great view to use. But yeah, that was a low volume rally into the 20-day line. Now you'll notice you also had a low volume rally into the 10-day line. It didn't fail there. So just because you can label it as such doesn't mean it's going to work. You have to use your stops. You have to also, as I said earlier, avoid short sellers high and just kind of sit back and let it come to you, okay? Because they will come to you, all right? And they sure have over the past 2 days. But if you stood in there too early, you may have lost, you may have lost your scalp or maybe more. Anyways, what else? Somebody said, who's in charge of Fed or OPEC? Well, I wouldn't make a big deal out of oil prices as a factor in inflation because they're really not. Inflation exists on a number of other levels, and it's increasing, okay? My daughter just moved back to LA from Santa Cruz. She was working as a vet tech, thinking about going to veterinary school, but now she wants to go into genomics research. So she's looking for an apartment, and she's been looking for a month, and the prices keep going up, and the landlords are pretty intransigent and kind of obnoxious. And I told her, that's good. Just hang loose. When the property market collapses, I'll buy you a condo. How's that? So, but my point simply being that a lot of components of inflation are continuing higher. And I think you're going to see the CPI number next week is going to really roil the markets. So anyways, that's all I've got. I think we're done. We've gone on too long, but I hope you guys get a good idea of what's going on, maybe some ideas and how to handle this. But I think if we break through the lows, if this rally fails in the worst possible way, and what I would point out as an example, let's pull up the NASDAQ. I love this chart. I show it a lot. But if we go back to 2008, in this rally right here, I showed you this before, okay? I don't think I want to pan the size that big, but this rally right here, that was a 12% rally, and it occurred on a undercut and rally type move. So let me just back it up. So you can see how it was an undercut and rally that took a couple of times to get going. It tried to undercut and rally here, and it failed through this low, okay? So and then it failed, looked like it was going lower. Maybe remind you of Friday, right? S&P went to lower lows. And then boom, you get this massive rally for 2 days right into the 50-day line, and that's when the fun starts. So, I'm fantasizing right now that we're in a similar position right now. We're going to blow to lower lows from here in rapid fashion. You've got the jobs number on Friday to help it along. You've got the CPI and the PPI. I think the PPI comes out on Wednesday, the CPI on Thursday. So I think things are about to get very exciting. So anyways, pull up a chair, some popcorn, and your favorite beverage. Mine would be a vodka martini, and enjoy the show. Anyways, that's it for now. We'll catch you guys next week. Take care.
So long, everyone.